Yeah, so I'm not sure I exactly got your question, but one of the things I do focus on is the nuance of low risk and high uncertainty. Is that what you were asking?
Yeah.
Yeah. So basically, the thing is that stock markets hate uncertainty. So what they want is you produced $1 in earnings this year. Please produce $1.10 next year, $1.20 2 years from now, $1.35 3 years from now, and please go nonstop like that. Okay? And the reality is that the business world is very messy. It just doesn't work that way. You know, things just don't go in a straight line, and they go up and down and such. So stock markets have, in my opinion, a irrational, extreme expectation of smoothness in business operations, and almost any business is anything but smooth. And so if a business has a temporary hiccup, you know, they just say, hey, by the way, next quarter might be slightly off, taken out back and shot. First, let's take it out back and shoot it, then we'll ask questions, okay? And you know, Buffett had mentioned that when he was buying the Washington Post, I think he was the market cap of the company was around $80 million. And he said in any private transaction then, it would have sold for $400 million. So it was sitting at about 1/5 of liquidation value or the sale of a private, what a private buyer would pay. And the 80 million market cap went down to 60 million because people just kept selling the stock. And the sellers, and Warren knew some of the sellers, they agreed with him that the private market value was 400 million. But they just didn't want to deal with the near-term uncertainty that the business was facing. So if you have a business which exhibits very high uncertainty, then that business generally will get very extreme kind of valuations in a auction-driven market, and an investor can take advantage of it because markets get confused between risk and uncertainty. They get confused between these two. And to give you an example, I had made an investment a few years back. I think this was like in 2004 or so, maybe it's been 14, 15 years. There was a steel company in Canada called IPSCO. And the nuances of this company were as follows, that the stock was trading at $45 a share. The company had no debt. It had $15 in cash. And it had contracted revenues and certainty of earnings and cash flows for the next 2 years, which were $15 a share each. So the company would make after tax $15 in each of the next 2 years. So in effect, I was paying $45, and if I just held the stock for 2 years, I would have $45 sitting in the company. But I would still have all the plants and everything else. But the business was extremely volatile with extreme cyclicality. So after 2 years, there was no certainty of any kind of what earnings were going to be. You know, wide range, unknown. And markets don't like that. So what did the market do? It priced it at 45. And from my perspective, I said, okay, why don't we just buy the stock and wait for 2 years? And because I have all the plants, I have everything else, I just want to see what happens after that, because they don't have Doesn't look like they have too much downside. And so we bought at 45. A year later, the company announced that they had one more year of visibility. They want to have another year of $15 earnings. So now we were in the money, and the stock went to $65 because we now had, in effect, $60 coming in. And then in a few months, it drifted close to $90 because I think markets probably started realizing this is ridiculous because you're not giving any value to the plants and all of that. And some Swedish firm came and offered $160 for the business. And the stock immediately went for 1 to 153 or something. I didn't even wait for the deal to close. We were out of there. And I still don't understand why that Swedish firm didn't come and buy them 2 years earlier. But that's the way it is in life. Like Mark Twain says, truth is stranger than fiction because fiction has to make sense. So uncertainty really bothers markets.